Inheritance tax. It's one of the most talked about and honestly, one of the most misunderstood taxes in the UK. But what if a lot of what we think we know about it is just plain wrong? We're going to dive into a landmark report from the Office of Tax Simplification that uncovers what's really going on and how this whole system could be made a whole lot simpler.
All right, first things first. We have got to get one huge misconception out of the way. Despite its reputation, very, very few families in the UK actually end up paying any inheritance tax.
And this is where it gets really wild. Just look at the numbers. Every year, there are about 590,000 deaths in the UK. Now, for almost half of those, 275,000 estates, families have to fill out these complicated inheritance tax forms. But get this, the number that actually end up paying a single penny in tax, it's less than 25,000. We're talking less than 5% of all estates, so that's a massive amount of stress and paperwork for a tax that almost nobody pays.
So, if hardly anyone pays it, why does everyone seem to hate it? Well, this quote from the report absolutely hits the nail on the head. It's a tax that pops up at the worst possible time, when families are grieving, and its rules are so confusing they can lead to outcomes that feel totally unexpected and, frankly, unfair. That emotional weight is the real reason it's such a hot-button issue.
And if you want to see just how confusing it can get, you have got to look at the rules around gifts people make during their lifetime. This is where things get really, really puzzling for so many families.
So the basic rule sounds simple, right? You give a gift to someone, and as long as you live for another 7 years, it's usually totally free from inheritance tax. But if you pass away inside that 7-year window, tax might be due. Seems straightforward, but yeah, it's not.
Because here's the catch. The way that simple 7-year rule interacts with other rules, especially the tax-free allowance everyone gets, can create some completely bizarre and unfair situations that no parent would ever want for their kids.
Okay, let's walk through this case study from the report. It's a perfect example. So you have Sarah. In 2015, she gives her son, James, £325,000. The next year, she gives her daughter, Claire, the exact same amount. She's trying to treat them equally, right? But then she unexpectedly passes away in 2018. Now look at the outcome. James pays nothing. Claire gets hit with a tax bill for a massive £130,000. How is that possible?
So what on earth happened there? It all comes down to how the tax-free allowance is used. The system applies it chronologically. So Sarah's entire £325,000 allowance was completely eaten up by the first gift she gave to James. That meant when Claire got her gift a year later, there was no allowance left at all. Her gift was completely exposed, and she got hit with the full 40% tax rate. It's a classic gotcha that punishes people for not knowing the system's weird little quirks.
So, seeing these kinds of messes, the Office of Tax Simplification didn't just point out what's broken. They actually came up with whole packages of common-sense fixes to sort it all out.
The big question they were trying to answer was pretty clear. How do we turn this system from a minefield into something that people can actually understand and navigate?
All right, here's their game plan. Part 1. First off, that 7-year rule for gifts, they say, let's cut it to 5 years, which just makes sense. I mean, who keeps financial records for 7 years? It would instantly reduce the paperwork burden. Next, they say we should just get rid of confusing rules like taper relief. It's this ridiculously complex sliding scale of tax that almost no one understands. Scrapping that and another obscure 14-year rule for trusts would mean fewer traps for people to fall into. It's all about making things clearer.
But they didn't stop there. The report also took a hard look at the tangled mess of exemptions for smaller gifts, which is another area where people just get completely lost.
And the solution here is just beautiful in its simplicity. Right now, you're trying to juggle different little allowances for things like annual gifts, wedding gifts, you name it. The OTS says, just scrap them all. Replace the whole lot with one single, clear, personal gifts allowance. One number to remember. Done. They also want to reform this other notoriously tricky rule called normal expenditure out of income, which is so complicated that really only the wealthy can afford the advice to use it properly.
And if you need any more proof that these rules are stuck in the past, get this. The main annual gift allowance has been frozen at £3,000 since 1981. If it had just been updated with inflation, today it would be almost £12,000. It just shows how much the value of these allowances has been worn away over time.
Okay, so we've covered the confusion around gifts, but the report found another massive issue where inheritance tax actually creates weird distortions in the system, especially when it bumps up against capital gains tax.
It all centers on this thing called the capital gains uplift. Let me explain it in plain English. Say you inherit an asset. When you do, the taxman basically hits a reset button on its value. For tax purposes, it's as if you acquired it on the day the person died. So any profit or capital gain that built up over their entire lifetime, poof, it's wiped out.
Now, this is where that creates a really bizarre incentive. A lot of businesses and farms are exempt from inheritance tax. If an owner passes one on while they're alive, the new owner might have to pay capital gains tax on it down the road. But if they hold on to it until they die, not only is it exempt from inheritance tax, but that capital gains uplift completely erases any built-up profit. The system is literally telling people, don't pass on your business, wait until you die. It can stop businesses from being passed to the next generation at the right time.
The solution proposed is just good old-fashioned common sense. Level the playing field. They say if an asset gets a big break from inheritance tax, it shouldn't also get its capital gains wiped out. Instead, the person who inherits it just takes it on at its original cost. This gets rid of that weird distortion and lets families make decisions based on what's right for the business, not just what's right for the tax man.
So when you pull all of these proposed fixes together, what's the big picture? What's the end goal? Well, it's really about creating a system that actually makes sense to the people who have to deal with it.
And this chart really helps put things in perspective. Even for the very few estates that do end up paying tax, you can see that the vast majority of the value, almost 80% here, is covered by standard, normal allowances. The tax itself is only ever paid on a relatively small slice of the pie.
And that really is what this whole report is about. It's not just about tweaking a few rules here and there. It's about making the tax system more intuitive so people aren't blindsided, more predictable so they can actually plan their lives, and fundamentally, just making it fairer so you don't have situations where two kids get the same gift but end up with wildly different tax bills.
Which leaves us with one last big question to chew on. This report lays out a brilliant roadmap for how to simplify inheritance tax. But when a tax system is so complicated that it needs this much work just to make it logical, you have to ask, is it really the right tax for today?